This is the first section of the afternoon, and section to debate 3 papers on competition. Competition is also part of the central bank agenda in the last few years. And in 2021, the mandate of the central bank to take care of competition and innovation in the financial payment system was already in law. 2 of the papers that will be presented today are related to initiatives of the central bank. One is loan portability, other is to improve the scope of our credit database. And the third paper is about IT expenditures by banks and non-banks. So just to remember that we're going to have 20 minutes for the presentation, followed by 8 minutes for comments and 6 minutes for debate of the audience. We're going to start with Amanda from São Paulo School of Economics of Fundação Getúlio Vargas. And her paper will be commented by Raquel from the Central Bank. Okay, then Amanda, the floor is yours. Okay.
Então ali.
Sim.
Pode ficar como
Não,
quiser.
se você quiser ficar aqui, no púlpito, como você queira. Okay. It's each side, when it's more comfortable for you.
So, good afternoon to everybody. Thank you so much.
Sem micro.
Oh,
Sorry.
good afternoon to everybody. Thank you so much for having me here. So this is our presentation. This is a joint work of these co-authors, so Bonomo, Thiago Cavalcante, and Fernando Chetma from the Central Bank of Brazil. And to give some motivation why this is important, so we always say in Brazil that the banking sector is really concentrated, and this is not changing over the years. So when we look at this HHI chart, when we look at this chart of the HHI index of new loans by municipalities, we see that between 2012 to 2016, this concentration, it did not decrease over the years. And when we look into the second chart, we see that around 80% of new loans were originated by just 8 banks. And this concentration after this period just increased because we don't have this HSBC bank anymore. So this is just getting more and more concentrated in Brazil. So this paper documents the loan portability regulation that the central bank implemented some years ago. And it uses a very comprehensive data from the central bank, that is the SCR database, and it has data of all the loans and between firms and banks, and also households and banks in Brazil. So we try to quantify the importance of the loan portability in the country, and if this portability resolution was effective to diminish bank concentration in the country or not, and the household channel and its implications. So the loan portability is used as an exogenous variation in local competition, and we explore this heterogeneous relation among municipalities in the country. We are going to show evidence that the loan portability was effective to decrease bank concentration. This is that this was effective to increase the volume of credit in the economy and decrease interest rates, at least for a fraction of loan types and group of people in the country. And we also acknowledge that there are still some inefficiencies and some room to improvement, and for this resolution to be better known by the public. And what is the loan portability. So it was implemented in December of 2013 by this resolution here. And I have to change, sorry, I have to change and use this. So it was implemented in 2013, and it entered into force in May 2014. So how does the loan portability law work? So a debtor has to go to another bank and check the conditions for interest rates and conditions and maturity and all of that. And the new bank can offer a lower rate for this client. And the central bank created a platform that is more transparent and standardized. And the client doesn't have to do pretty much anything else. The banks communicate between themselves, and this loan can be ported. So consumers should not be charged for anything except for housing. And the original institution have the right to give a better loan price to this client in case it thinks it's convenient. So that the original institution has the right to match the competitor's price. Okay, so these were the most ported loans between this time from 2014 to 2016 were payroll loans. So when we look into the number of operations and the value, the monetary value, we see that pretty much there was no other loans being ported among this time, just payroll loans. So this is why we are going to focus in this presentation, in this study, just on portability, or just on payroll loans. And what is a payroll loan? So a payroll loan allows the bank to deduct the payment directly from the person's paycheck. And we are going to see another chart in a minute. And pretty much, this is a kind of loan that is dominated pretty much by civil servants and retirees. Although other formal employees could also use this type of loan. So the average maturity is around 5 years. There are limits, maximum limits for interest rates for both retirees and civil servants. And there is a maximum of your paycheck that you could compromise with this loan that is around 30%. It can go up to 40% depending on the months and the time of, for example, in the COVID period, it could go up to 40% of your paycheck. So this is the, so this is the fraction of payroll loan that goes to each of these categories. So we see that this goes pretty much to civil servants and retirees, right? So pretty much all the loans goes to these two groups. And why should a person be interested in taking a payroll loan? Just because interest rates are much lower than other similar categories. For example, personal loans have much higher interest rates than payroll loans. And when we look at this map and compare these 2 years, 2014, 2017, and when we look into across municipalities, we see that, it gives the idea that the interest rates didn't change much along these years. But when we see this other chart here, we see that in reality, the interest rates in reality changed for some groups, some specific groups, and this is one of them. So when we look into retirees, we see that the interest rates on ported loans didn't change much, but when we look into civil servants, we see that it really changed a lot for this specific group. Okay, so our contribution with this paper is related to bank competition and its effects on financial variables and real variables. We also interact with household credit channels. So we have a lot of papers that try to figure out the implications of firms' credit to the economy, and we have very fewer papers look into these implications for households. We also interact into these loan portability papers that try to understand the effectiveness of these measures to the economies. We have this first paper that analyzes this same law for Brazil, and the second one that analyzes this law for Chile, but we have portability in Mexico, Spain, and several other countries. And we also interact with these papers related to the potential impact of new technologies and new regulations in the banking system. So the data that we use are these ones here. The second one is the sexy one, because it is detailed records for households and banks. And I can see every person, the loans that this person have, the maturity, interest rates, and all this very specific information. So the methodology of the paper is this one. So we use this portability loan resolution as a source of exogenous variation in competition in local banking markets. So we are using municipalities as our analysis, and after that we use a difference in difference research design to estimate the causal effect of this loan portability law on bank competition, and we want to know what happens to loans and to interest rates. And we say that treated market is the ones in the darker green color. So a treated market is a market that had at least 2 different banks in December 2013. That is the time that this law, this resolution was implemented. And what I mean by that, we have to have 2 different name banks, for example, Itaú and Bradesco, or Itaú and Banco do Brasil. We had to have at least 2 different bank branches. And we also look into the intensity of this bank concentration in our analysis. So this is our specification. So we use a difference in difference regression, and we want to uncover this delta parameter here. So these are our results. First of all, some statistics. So what we see that in this period of analysis from 2012 to 2016, the average payroll interest rate was around 28%. So we have a spread, 17 percentage points spread when we compare to the central bank target rate, that is the Selic interest. And we also have here that we had around 2 different bank branches for each municipality on average, right? That is not a lot, even because we have very big cities like São Paulo that have a lot of different bank branches. We also had a very percentage of public banks at this time. So we had around 57% of public branches in the country. So when we look into this chart, we see that parallel trends hold. So we are safe to use difference in difference here. And then we can go to the results. So here in this presentation, because of time, I'm going to show just the results for interest rates. But in the paper, we are going to provide results for loans and other variables too. So when we look into prices, how interest rates varied for payroll loans, we see that we had 0.8 percentage point reduction in interest rates at this time, and our methodology, in our methodology, we see that it was a causal effect. So the loan portability law was effective to reduce in 0.8 percentage point the interest rates for payroll loans in the economy. And even this third column that looks a little bit lower, around 0.5. When we look into the intensity of this treatment, there is a municipality going from from being a very concentrated place for this 8 HI to being around 10,000 to going to the average that is around 5,600 thousand, we see that the effect was much higher, around 1 percentage point of reduction. So we have these around 0.8 to 1 percentage point reduction in interest rates because of this portability resolution. But as I showed you in the charts before, this reduction was very heterogeneous. So we had some groups that benefited more. So when we look into the same regressions for just the subsample of retirees, we see that the reduction was pretty much the same that we see for all the economy as a whole. But when we look into the sample for civil servants, we see a much higher reduction. So we see a 0.4 percentage points reduction in interest rates for this group. To check the robustness of our results, we did some other exercises. So we excluded municipalities that are bigger, that have more inhabitants. So we ran regressions just for municipalities that had at least, at most 200,000 inhabitants, and we get pretty much the same results. Then we checked what would happen to the regressions if we used the treatment variable as occurring in May 2014, that was the date of the enactment of the law, instead of December 2013, that was the date that this law was announced, and we get pretty much the same results. And we also did regressions for the volume of loans, and we show that the volume of loans also increased by around 3%, and the interest rates decreased by around 0.8%. So this goes in the direction of saying that this law was effective in reducing bank competition during this time. We also have other results. So we did regressions for another 2 subsamples, actually 3 subsamples, but I think that it's more interesting to have these contrasting effects, high and low income. So we see that the results were stronger for high income individuals. And what I mean by that is that higher income individuals had greater reduction in interest rates than low income individuals. It goes hand in hand with the idea that if you are higher income, if you are better educated, you probably understand better financial contracts and are going to seek better credit conditions. And we also did some regressions for public and private banks, because a little bit earlier in 2012, we had a government that was trying to decrease interest rates, using public banks to decrease interest rates in the country. And we wanted to check whether this was driven by the law, the loan portability regulation, or by public banks. And we do see that when we have a subsample of just public banks, we had a higher reduction, but it is this. We also get a result when we have the whole sample for public and private banks. And also to check the robustness of our results, we did some placebo regressions, and we used the treatment starting 1 year before, in May 2013, and we don't get significant results. So just to conclude, we can say that the portability was effective to promote competition in the Brazilian banking market, at least for a subsample of the clients. We also acknowledge that collateral is really important, because at least at this period of analysis, we see that payroll loan was basically the only loan that was ported. Now, more recently, in the last 2 years, we see something happening with housing, but at this time it was pretty much payroll loan. And we also find evidence that occupation, education, and income are very important variables in the decision of seeking better credit conditions. And maybe this is our way to go to better these measures and initiatives. And we also acknowledge that this loan portability resolution is not well known by the general public. So there was a Datafolha survey very recently that was sponsored by these fintech banks in Brazil, and it says that around 60% of the population does not know that the credit portability exists and that they could go to another bank and try to seek better credit conditions. So we see significant room for improvement by advertising, maybe by the central bank, right? Because everybody knows PIX, but pretty much nobody knows that you could go to another bank and seek better credit conditions. And this could improve welfare for the whole society, pretty much as PIX did. And also now we have open banking, so we could go in the other way around. Maybe the the client does not need to go to the bank and check better conditions. The bank could call the client and offer better credit conditions, as we, at least in Brazil, for the Brazilians in the audience, really happens in the telecom company. And I think that this work can have implications for firms' portability, that collateral is really important and could be a problem for if we are going to have portability for firms in the future. So thank you so much.
So thank you, Amanda. Then let's switch to Raquel with comments.
Hello, everybody. I hope you're all, what? Okay. I did the opposite. Now I can, okay, this is good. Obrigada. Thank you, Mikio. So, yeah, so it was very interesting paper to read. And so I'm gonna give you some of my comments and questions that trying to help most of the time. So this paper, as Amanda has just presented, is co-authored by one of my colleagues at the Central Bank, and Thiago and Bonomo and Amanda, right? So what is the paper about? As I understand it, it's an investigation if loan portability affects competition in local credit markets. That's their idea. Okay. And what do? They use, oh, thank you. They use a regulatory change that was aimed at improving the process of portability. So you could port your exchange, you go to the bank and they ask for the loan to be ported, which means another institution is going to repay the loan, and you're going to have this better conditions in another bank. So that's the idea of loan portability, and you could do that prior to this change, starting in 2003, right? So what happened in this regulation that they're investigating is changes to improve the process of portability, and that's the idea. So they consider that treated municipalities are places where they had at least 2 different banks by December 2013. And they assume that this is a necessary condition for customers to find a lender that's interested in porting the loan. And this is something I'm going to mention a little later. It focuses on payroll deductible personal credit, which they're going to call the payroll loans, right? Which is a type of loan that is the most commonly ported. Until today, it is the most commonly. And they use a difference in differences setup that's similar to a paper by Gustavo Joaquim and Bernardus Van Doorne, 2019. And they run the analysis at the municipality level. And the outcome variables are loan volume per capita and interest rate. This is from the version that I read, which I know is not the latest version as we talked before, right? So my, overall comments are, this is an interesting investigation on the topic of loan portability, and the novelty is that there's very little investigation on that topic. Now, my main concerns. So the main one is that the definition of treated municipalities rely on this assumption that borrowers would be unable to port their loans if they lived in municipalities with only one bank. And in this particular case of payroll loans, it disregards the role of banking correspondents. And a great fraction of portability of payroll loans is initiated, I don't know if that's the correct term, but it's more of an offer by a banking correspondent rather than an active role of the borrower. And that is something that I think is worth investigating a little more, so to see if these ported loans are in fact the result of this active search or an active search by the competitor lender. So it's important to check this and check if this assumption is backed by the data, if it's harder for borrowers in municipalities with only one bank to do that, right? I think we need, the paper deserves a little bit of putting it in context within the literature and bring a little bit of the theoretical argument to fit it in more in the literature. And there's a few questions. So I would like to see in the paper more of some more first order effects, like if this regulation was aimed at improving the process, has the process improved? So is there a smaller chance of canceled, pending, and suspended cases? That's something that's kind of easy to check. Also, I would like to have seen the reason why some types of credit are most ported and benefited the most by this new regulation. And also, I think because of this is a very specific type of credit that they're looking at, I think it's important to state the limitations of this study, considering that payroll loans are catered to a very specific selection of borrowers. And so I think this is something that should be in the text, right? And it's, for me, it was unclear what the sample period was. So I think it requires some clarifications. Some of the things that I would like to talk about identification. Well, the first one is that the outcome variables that are presented in this version, which are interest rates and loan volume per capita, are not measures of competition per se, right? So we need to maybe reframe it a little bit. Also, one of the control variables is the HHI, and I don't think, well, if we think that that competition is affected by the new regulation, then it might as well be another outcome variable, and we cannot rule out that one outcome affects the other outcomes, so this should not be a control variable. And they're, like Angerst and Pischke would call them the bad controls, but now we have other papers like these, which is a theoretical paper, and would be model 11. And this is an empirical, more applied paper that talks about that. Right. And also, maybe some, I would like to understand why the analysis was in the municipality level. And also, it would be nice to see if which lenders are the ones that receive the ported loans, because at that period of time, as we saw yesterday on the presentation in the session yesterday, was that state-owned banks initiated a major payroll loan expansion in 2011, which could affect the results, right? The last comment that I want to make, and the rest I'm going to send them to you, is that, and it's kind of a commercial, advertising. So the banking reports of the central bank since 2017 have included sections and special studies devoted to loan portability, with a wealth of information that could help guide this analysis, right? For instance, one idea is that porting a loan is most likely when the base rate, Selic, is going down and lower rates follow suit. That's the main driver that has been found behind portability. Okay, thank you, everybody. So,
thank you, Raquel. Then let's go to the audience. Who wants to start? Question, please.
I think it was raised in the discussion, but I am super curious to hear your thoughts on why some types of loans were so successful in being portable and others not, and more on the background. How was this intervention resolution announced to the public? That's where, like, there's so many interventions or resolutions that go through, and so many, in so many cases, no one knows about them. So what was going on then? And the other is also similar. So do you see if clients are moving also to from private to government-owned banks, which is interesting because Brazil has these settings where government banks are such an important player, no? So it would be interesting to see.
Okay. Anybody else? Question? I have a question that maybe your test didn't capture one effect, that it's the portability is not concluded. You didn't, the client doesn't move the credit to other bank, but the fact that the person is trying to move creates a threat to the original bank, and the bank sometimes they meet the original proposal, and then they have a negotiation of the original credit with lower rates. My question is that your econometric, is your test captured this effect or not? And if not, I think it's an extension that was to be done in your paper. Okay.
Yeah, I was hearing the presentation, and you talk about that the public bank was the ones that offered the most payroll loans at the beginning of this time. So I think an interesting test would be just compare those banks and in place where they face competition in comparison where they don't have competition. So that would be an interesting thing to see if there's, for example, Banco do Brasil reduced more where they face the competition for an aggressive private bank in that particular market.
Then no, it's okay, Amanda, you have time to answer the questions.
So I'll try. I hope I remember all the questions. I'm very bad at remembering sometimes. So your first question was about why some types of loans were most ported than others. I really don't know the answer for this question. And I think that my idea is this to be another paper, why people take advantage, what are the psychological or maybe the behavioral behavior of clients that sometimes take advantage of these settlings and others don't. So what I know, but this is anecdotal evidence, I don't have anything to prove, is that, for example, for retirees, there is an intermediary between the borrowers and the lenders, and they try to talk to retirees and they help with this process. So there is an intermediary that is helping them with this process, but I really don't know. Well, it looks like collateral played a role in this because payroll loan has a very good collateral, right? There is your paycheck, it goes to the bank, and it is deducted directly to the bank. So I'd assume that collateral is really important and that this intermediary is really important, but I don't know. This is another investigation to be done. I don't have any other information of how to check this. This is just my best guess. And your second question was, I forgot, sorry.
If clients are more likely to go to government banks.
Yes, this one I can check. I haven't done that. What I can say that it's pretty much similar to your question is that what I see is that when I compare a sample of just private banks, a sample that I have private banks in control and private banks in the treatment, I see that there was a reduction there was a little more aggressive than when I have just private banks in control and in treatment. So I see that private banks were playing an important role in this, but also what I see is that when I have just public banks in control, they were not reducing interest rates as aggressively as when I see public banks in treatment. And what I mean by that is that when public banks had no competition, they were not actively reducing interest rates, but when they had a competitor, then they really did reduce the interest rates. So I have to try to work better and try to find a way to present this here, but I see these effects. So there was public banks were a driver, but it was not the only driver. It was a driver just when they had competition of other banks. So this is we see in the data. And then your question, so Angela said that, for example, there is portability loan just when you really move banks. So you had a loan in one bank and you go to another bank, then the portability was effective. But you can have a reduction even if you don't change banks, right? You can stay at your bank and this first bank can give you better conditions because you were trying to seek another bank to change. So my econometric exercise is effective to capture this effect too, because I'm not looking just to ported loans, I'm looking to all the loans in the economy, so it is effective to take these results too.
Okay, thank you. Okay, then let's move immediately to Raquel with the second paper on does loan portability, showing information sharing access to finance, law, contract design, and labor market. Okay.
Okay, so here I am again, hoping to keep everybody awake, perhaps entertained. Let's see. So this is joint work with Thorsten Beck and Patrick Baer, and me. I'm the only Brazilian. As you can see, they're both German. And now I have a German as a discussant, so what can I do? That's it. Of course, the usual disclaimer applies. The views here are mine and ours, actually, and do not reflect those of the Central Bank of Brazil. So the title of this study is Information Sharing, Access to Finance, Loan Contract Design, and the Labor Market. So it's a very long title, and it's a long paper. It has more than 15 tables, and of course, there is not enough time for me to go about each table separately, so I'm going to take a different approach, and I'm going to focus on the main findings and hopefully not show you any tables. So let's move on to the motivation. We all know that this issue of asymmetric information is one of the main obstacles for micro and small firms to access formal finance, especially in developing countries. And credit information sharing has been regarded as a policy tool to try to overcome these market frictions. In this study, we're going to use the lowering in the reporting threshold to the credit information system in Brazil in 2012 to assess the impact of information sharing on each of these themes. So it's access to finance at the extensive and intensive margin, loan terms, loan arrears, and firm employment. And theory informs us that of at least 3 possible effects of information sharing. One is the disciplining effect that would reduce moral hazard behavior by borrowers. The second is the screening effect, which means that lenders would be better able to differentiate borrowers' risk profiles. And finally, we have the competition effect, in which information sharing allows borrowers to build up reputation and reduce rents of lenders. And theory also informs us that the effects could be different for low and high risk borrowers, and also that different types of banks may react differently. For example, incumbent banks may try to defend their rents, whereas new lenders may want to acquire new clients. And big banks versus small banks could also work differently on being more transaction-based or more relationship lenders. So here I'm trying to show you the characters in our story. And we have firms that are the borrowers, and they could be risky firms, prime firms, which is very low risk, and good firms, which is in the middle ground. We have the incumbent lenders, the credit registry right there in the middle. It's a microscope. That's the best figure I could find. It took me a few, but I didn't get any better than that. And we have the new banks, and the new banks, they could be either small or big, and they could also be private banks or government banks, foreign banks, and even credit unions, right? So these are the characters that we're going to be looking at. And the paper is related to, of course, the theoretical and empirical literature on credit information sharing, but also on literature on bank ownership and the literature in labor and finance. So let me try to explain our setting. The central bank runs a credit registry with a wealth of information on loans, and we've seen many papers using that already at the conference. And these informations are sent by all of the financial institutions to the central bank monthly. In 2012, the reporting threshold lowered from 5,000 reais, which is approximately $2,600, to 1,000 reais, which was approximately $500 at the time. And in our setup, we have the treated firms, which are micro and small firms that could not be found in the credit registry before the threshold change. And after this regulatory change, we can see them, and we can see the loans that had been granted to those firms in the prior year in a context of no information sharing. So that's the main idea, right? We have data from different sources. The main ones that we're gonna, worth mentioning right now are the SCR, which is the credit registry, and the HISE data, which is the labor data. Of course, but there are other things, right? And we have the pre-period is 2011, and the post-period is 2012. As I was mentioning before, we are focusing on micro and small firms, and and we can also see their different risk profiles. So what we consider the lowest risk, which are the prime firms, are firms that didn't have a loan past due for longer than 14 days. And on the other end of the spectrum, we have the risky loans, which had past due loans, or non-performing loans, because they've been past due for at least 90 days in 2011, and the good are in the middle, right? So this is the regression setup. We have firm level, and which are the top two, and loan level regressions. The firm level regressions are used to investigate labor outcomes and access to finance. The loan level regressions are used for the investigation of low contract design. The difference in differences regressions have post-dummy, right, which means the average over 2012, the treatment dummy, and 2 observations per firm, and standard errors clustered at the firm level when we're talking about the firm level regressions, of course, and also in the loan level regressions, it's the same, but we have monthly frequency. That's something I forgot to say. So I'm going to skip to the results. So in terms of access to finance, our findings are consistent with the competition hypothesis. We find that financing constraints are relaxed for treated firms. There's a higher probability of adding a new lender for risky borrowers and a lower probability of adding new lenders for prime borrowers. We find that private banks, foreign banks, and big banks are more likely to start new relationships. Treated borrowers receive larger loans. Now we're talking about the intensive margin, right? Treated borrowers receive larger loans after the inclusion in the credit registry, especially those that get new lenders. And good borrowers benefit the most in terms of increasing the credit available, followed by risky and prime borrowers. In terms of the loan contract design, we're going to look at the interest rates first. We find that interest rate reduction is driven primarily by competition. Incumbent lenders reduce interest rates on loans to treated borrowers. Good and prime borrowers get lower interest rates from both incumbent and new lenders in case they switch banks. Risky borrowers get lower interest rates by government-owned banks only. In terms of maturity, we find a disciplining effect with shorter maturity loans. Incumbent lenders lose their information monopoly and discipline by offering shorter maturities to treated borrowers. And the reaction of new lenders depend on their type. Shorter maturities are offered by foreign and big banks, and longer maturities for government-owned or small banks. When you're looking at collateralization, so pledging for collateral, right? It's also a disciplining tool. So there's lower collateralization for treated borrowers. Incumbent lenders lower their demand for collateral when there are no new lenders. And for new lenders, hard assets replace partly hard data. Risky borrowers benefit from lower collateralization from new small lenders, foreign banks, and credit unions. On the other hand, good borrowers are less likely to pledge collateral in new relationships with credit union, foreign lenders, and small lenders, but are more likely to post collateral for new government lenders or big lenders. And prime borrowers do not benefit from lower collateralization. In terms of loan arrears, right, we find loan arrears for incumbent, lower loan arrears for incumbent lenders. And this effect is driven by risky borrowers. We find higher arrears for lenders, for new lenders and risky borrowers, which points to a trade-off between discipline and better access to funding. I'm going to skip that one in the interest of time. And then in terms of the labor market, in line with the labor finance literature, we find higher employment, and the effect for risky borrowers is driven by private lenders and credit unions. To conclude, the inclusion in credit registry resulted in expansion of bank funding for firms. The incumbent banks react with lower interest rates, lower collateral, and also, or contrasting, they lower the maturity. So they shorten the maturities of the loans. The new lending, primarily by banks, more likely to use transaction-based lending techniques, but they charge higher interest rates and lower loan arrears for incumbent lenders, but higher arrears for new lenders when lending to non-prime borrowers. Okay, so it ended up that I have time to show the tables. So this is the descriptive statistics. It's kind of unusual that I'm going to show this at the end, but I was afraid I was going to run out of time. So this is the descriptive statistics and the firm level. Each firm has about 7 loans, right? The descriptives for loan level. The extensive margin, so we could see the increase in the number of lenders. But as you can see here, the number of lenders, the mean number of lenders is 1.25, right? We're talking about very small firms. But even for the average firm in Brazil, they don't have, they have around 2 or 3 banks, as I remember. And this is the setup for when we're looking only at not the difference in differences, but only the new lending relationships after 2012, right? In the intensive margin, we can see that loans increase for these firms, right? And then I'm not going to bore you with the interest rates and the maturity. I think you get the picture. And I'm very happy that you are all awake, really impressive. And I'm looking forward to the discussion.
Thank you, Raquel. Then let's move to Yannick with comments.
Thank you very much for asking me to discuss this very interesting paper on information sharing, access to finance, loan contract design, and the labor market. Or in other words, what are the consequences of information sharing for credit and labor markets? I think that's kind of the summary of what this paper is trying to do. And that's obviously a very important question. It's of course, adverse selection is one of the most studied and discussed topics in credit markets, and when basically alleviating adverse selection, by information sharing. We are really interested in what are the consequences for the credit market, and then also how does it affect the real economy, and then employment is, of course, you know, maybe the most important thing, together with, like, let's say, investment. So this is a super important question, and it's very difficult to find answers to these questions because there are a lot of identification challenges. Of course, sharing information is always an endogenous, is always a choice. So when you share information, then of course you also reveal something about yourself. So what is the paper doing? It has a very nice setup. And so basically setup is that other banks that are in the credit register can obtain data on firms that are in the credit register, even if the bank itself is not lending, right? If I understood that correctly. So this is not the lending bank, but it's like the other banks that can access it. And then in 2012, there was a change in the reporting requirement. So there were more firms in the credit register that can then, that the other firms can, that the other banks can now access information on, right? And in 2011, it wasn't possible to access the data, but in 2012 it was. So it's a natural way to kind of set up this difference in different specification to see, well, these banks that suddenly now have access to the data, the banks that have access to the data in 2012, but not to 2011, what are they doing in 2012 to these firms compared to 2011 when they didn't know anything about that, right? So that's basically the idea. And so then you can kind of look at these types of firms that were, because of the change in the reporting requirement, were then included. And so what happens to them? Do they get more credit? Do they get more employment, right? So, and then the results, there are many results, but like, I think that the main results are that risky, newly included firms, so the treated firms, they increase borrowing, and the safe, newly included firms have lower interest rates. And then I think all newly included firms kind of increase employment. So that's kind of, there are a lot of results, but that's kind of what I took away from it. So, so my discussion is going to focus more, it's not going to ask for more results because there are lots of results. And so like, I think what would be useful for the paper is kind of to find a bit of a clearer theme, like what is really going on, so that we have like one takeaway. So I don't think it's necessary to like have, like to do more. So instead, I'm gonna try to give some comments how you can maybe improve the communication of the paper. So, and this is particularly the case for the setup. So I think the setup is great, but I think it can be communicated, can be conveyed in a clearer way. So it took me a while actually to get this intuition. I mean, maybe that's just my ignorance, but like I didn't actually know. So like what the way you talk about it is like you call it like the change in the reporting threshold in 2012, right? So I'm like, what does that have to do with information sharing? For me, it wasn't obvious at all, because so I didn't know that like the other banks can actually access the information, from the banks that are lending to these firms. So and I think you say that on page 8.
Yeah.
So I don't know if that's just me. I mean, I've worked with credit registers before, and I didn't know if it's standard in these credit registers, so like in the Colombian credit registry or kind of in the US credit registry. I don't know if they can do that as well. I mean, that's interesting, but I didn't know that. So I think that would be good to say. And then do the banks actually? So if I'm a bank and now I'm asking for like the information of a specific firm. Do they actually do that? Do we know that? Do the banks do that? Do you have information on whether they do that? I think that would be useful to kind of talk about that a little bit. And then the other question that I had is like, how can we even compare firms between 2012 and 2011 if in 2011 they didn't report, right? That was the other thing. It's like, it's really like, it took me a long time to wrap my head around it in the intro. So and then you say, well, they kind of fill it later, right? In 2011, then the lenders are reporting on what they did in 2011. So, and I think you say that like on page 14. So that's when I started getting the paper, right? So there's this kind of backfilling going on. So it's not that in 2011 they report on it. So I think, you know, here it would be really useful. It would have been very useful for me to make that clearer early in the introduction, or, you know, even in the abstract. And then there's another thing that, so not all firms are actually doing this information sharing. So when the firm is doing the application, there's a checkbox that allows the financial institution to access the client's data in the credit registry, right? So, but of course, so you really only care about these types of firms, right? Are you only using these types of firms, or are you using all types of firms? And so also, of course, if I'm a firm and I say, well, it's fine for the other banks, even the ones that I'm not that I'm not getting a loan from, to access my information, obviously that reveals something about me, right? So I'm probably going to be a good firm then in that case, which is maybe why you find that these risky firms that are willing to report or are willing to kind of share the information, why they actually benefit from this change. So I think it would be useful to kind of restrict, if I understand correctly, you include all firms. It would be useful to kind of look only at the firms that do disclose, and then kind of, I mean, compare the firms that disclose and that don't disclose, okay. And then, kind of make this comparison. And I think you should be able to do that, right? You can just pretend to be a bank and say, well, you know, like, which firms do I have access to, right? And then, you can compare these firms are only focused on this group, and you can do maybe like a placebo or something like that for the firms that do not disclose. So and then on the results, so there are many results, but I was like missing a little bit like a clear theme. So I think it would be nice. I mean, so it seems like, well, there's a lot of heterogeneity that seems to matter, but I think it would be nice to kind of focus on 1-2 results, and you really push these results and say, this is robust. And, you know, so like that we have one takeaway from the paper. I think it would be very nice. Like, I think the interest rate results seem to be pretty consistent across borrowers. So maybe you want to focus on that, because also like kind of, you know, you have a lot of like predictions from the adverse selection literature kind of on that. So actually, so you talk a lot about the competition hypothesis. So I think what would be nice to have a hypothesis section as section, whatever, 2, 3. And then you say, well, the competition hypothesis is saying this, and this, right? It's predicting this. And then you have, you know, kind of the adverse selection hypothesis is saying this, and this, and then you go to the results and they say, well, this is consistent with this, and this, right? So I think that would like make it a bit easier. Also, you have lots, I think like 12, I don't know, something like that, tables, but no figure. I mean, I like figures, but that's it. So I think it's a super important and interesting topic. It's super nice setup, great, but I think like if you can communicate, especially the intro, a bit better what you're doing and what the main takeaway is, that would help the reader, I think, a lot. Thank you.
Thank you. Thank you, Annie. Let's collect questions from the audience. Questions?
Nice presentation, Raquel. Just wondering, you have some regressions at the loan level, but how do you handle the heterogeneity of credit, of types of credit? So it was not clear. The threshold is very small, so I think the treatment group has very small firms. So what are the types of credit they cater more to these small, very small firms? And I think you passed the slides very quickly. What are the order of magnitudes of the effects? Are they economically important too? Not only statistically important, but economically important? Thank you.
One question is about poaching of good clients from, for instance, banks that are, the business of these banks are to serve like the bottom of the pyramid clients that tend to be more opaque. I remembered in Peru many years ago, there was a similar policy, and the cajas municipalities that cater like the unbanked borrowers complained a lot because apparently banks took the good clients and cajas were left with like the most, complicated clients. So their operating costs were really, really high. They ended up increasing a lot the interest rates for new borrowers, potentially good ones that were going to, develop a credit history with them. So there's also, it seems that there might be a downside also of these policies. Curious to hear your thoughts.
Okay. Yeah, okay.
Ok. Onde é que liga isso aqui?
Tá ligado, tá ligado.
Okay, so first, thanks for the questions and for the comments. I really appreciate your view, because so far we've only presented the paper, and it's different when somebody actually reads the paper and then can spot the holes and things that could be better explained. And it's so I really appreciate it. I think we need to work better on this communication. We had a very long introduction, and then we squeezed it and probably missed these details that you mentioned about the setup. So we're going to try to work on that. So about the firms, so all of them have to tick I agree to have my, if it's like the when you download an app, if you want to use the app, you have to check and say that you've read, which I never do, but most people, I don't know, because they don't read. I don't read. So if you want to use the app, it's a checkbox, but you have to check. So it's kind of the same thing here, right? You have to check that you allow the banks the bank to check your information at the credit registry. Otherwise, you can do business with it. So if it were differently, then it would be a great setup for what you said. Let me see what else about the communication. Yeah, it's really, we have results all over the place, right? So we need to clarify this. I didn't think about figures. Figures are tricky. I'm going to try to think about one and get it there. Let me see what else. I think, yeah, the back filing I mentioned. So I think, I think that's it. And I really appreciate it, because we're going to have to try to do a better job in being concise in the introduction, but not missing points that are not, that aren't clear. We get so into the business, and we think everybody understands how a credit registry works, which of course isn't the case if you're not working on it all the time. So I appreciate it. Ricardo, we are working with working capital loans and overdrafts. And also we are both control and treated firms are very small firms, micro and small firms. And and also, about the aftershock, right, that you mentioned. We don't know, because we only looked at the immediate effects in 2012, right? So we don't know how it plays out over time, right? If it accommodates, if it doesn't. But in the beginning, we do see that the incumbent lenders react, and they try to compensate and to offer lower interest rates and try to retain those borrowers. I think that's it. Thank you, everybody.
Okay. Thank you, Raquel. Then let's move to the third paper by Yannick, The Anatomy of Banks IT Investments, Drivers and Implications. Yannick, do you want to present here or there?
I stay here this
Okay.
time.
Okay.
Switch it up a bit. Do you hear this? Is it on? Yeah. Yes. So thanks for having this paper on the program. Yeah, it's, as you said, it's on the anatomy of banks' IT investment. So it's like a very broad paper. We do a lot of different things as well. It's joint work with Kosha Modi at Columbia, a PhD student there, Nicola Pieri and Maria Soledad Martinez Piera, both from the IMF. I'm from the board, so of course views are ours and not those of the institutions that we are affiliated with. So, so as you all know, there's a lot of interest in fintech lending, especially on the mortgage side, all over the world and in the US. And so just as an example, the share in US mortgage market of fintech lending increased from something like 3% in 2010 to around 15% in 2021. So it's really huge. And the biggest mortgage lender is now a fintech company called Rocket Mortgage, right? So there's a lot of interest in that, of course, and a lot of literature studying what the consequences of fintech are for mortgage lending and for the real economy. But then still banks are very important. And when you look at banks, I mean, they also adopt a lot of technology. At least they say so, right? So if you look at kind of the executives on some speeches that they give, they say things like, we see ourselves as a technology company with a banking license and these kind of things. So there was this like FT article where they reported that JP Morgan plots astonishing 12 billion tech spending to beat fintechs. So there seems to be at least a lot of IT investment of banks from anecdotal evidence, but then also banks seem really to be threatened by fintechs. And so here in this paper, we are really interested in kind of the evolution of banks' IT investment and what drives it, who really did adopt IT. So it's very descriptive in that sense. And then we're also interested in whether this IT investment, how did it shape kind of lending consequences, and did it make banks that now are kind of maybe more IT intensive, does it make them kind of like fintechs, or are they still different because they have like kind of different regulation or a different business model? So is the tech in banking similar to fintech, or is it really kind of like a banking with just a little bit more tech, right? So these are kind of the questions that we're interested in, and to what extent also, the implications of IT, what the implications of IT are for other things like the transmission of monetary policy. I mean, I think the first, so to take a step back, I mean, so there's a lot of talk about that, but then actually there's very little data available on IT investment of banks. And so Nicola Pieri and I, we have two other papers on bank IT investment, but the data is really very scarce. So what people have used in the past is this, and we have used in the past, is this hard-to-hangs data set that gives you measures on how many PCs bank branches adopt. And this is kind of like the most used measure at the moment. And so we were not super satisfied with this kind of measure, so we wanted to do something else. And so what we are doing in this paper is we actually use data from call reports to construct an IT measure. And so this is, I think, like the first contribution of this paper. And we make this data also available for anyone. It's on our websites. And so the way we go about it, so if you go to the call reports, it's not the case that they just say, oh, this is IT investment. So, but what there is there's the banks report the top 3 items of non-interest expense that are not otherwise classified. And so, but then they have a field and they say what this expense is. And it needs to be at least 10% of the non-interest expense. And so then we go through all of these fields and we look for words that are related to IT. So we look for words like web, software, IT, PC, computer, technology, and so on. And then we classify them as IT, and then we sum up all the expenses. So that's our kind of measure of IT. And so compared to these other measures that people have used, this Hart-Hanks measure, for example, the advantage is that it's the actual expense that the banks report in the core reports. So it's built from administrative data, while, for example, the Hart-Hanks data is kind of survey data, so it's a bit less reliable. It also has a long time series. It's publicly accessible for everyone, but you can just download it from our websites. And it's really the universe of US banks, while for the other measures, you have a much smaller sample available. However, as I mentioned, they only report the expense if 10%, if it's more than 10% of the non-interest expense. So that obviously puts kind of a downward bias on this measure. Then we also use some other data. So then we built this measure of bank IT expenditure, and then we, as I mentioned, we're interested in how this compares, how like banks with high IT compare in terms of their lending behavior to fintechs. So we use like a fintech classification from Buchak and Füster et al., where it's classified as non-banks that offer end-to-end online mortgage applications. And then we use some other data from Hamda, DealScan, and so on that are pretty standard. So first, let's look at whether it's actually true what these bank executives are saying. So here we're plotting the IT expenses from 2000 something like 2000 until 2021. So you see it's a pretty long time series, and so you see IT expenses are skyrocketing, especially starting in 2010. And I mean, of course, you know, everything is kind of going up during this time period, but if you look at assets or non-interest expense, they go up much less. So to some extent, it is true that banks are ramping up their IT investment. Who is it? Is it the case that it's only the big banks? Yes. Basically, if you split banks into deciles, you can see it's really driven by the largest 10%. Right? And that's not the case because they report more or less. It seems to be kind of the reporting doesn't seem to really introduce a bias here. So really, like IT investment is going up for the big banks, while it hasn't really changed much over a long time period. So this is divided by non-interest expense for the other types of banks. So then the next step is, so what drives IT investment? So we already know like size is driving bank IT investment, but let's go back to this other quote from the FT that says, you know, JP is ramping up their IT investment because they are trying to beat fintechs, right? So we tried to test that by looking at the exposure of fintechs that these banks have. And so we can look at the mortgage market and see where fintechs are lending. And then we can see whether banks that are lending in the same area or like are based in the same area, whether these banks are ramping up their IT investment more than the other banks. So this is kind of, so we compute this exposure to fintech, and then we see whether this correlates basically with the IT investment. And then we're also interested in other characteristics. So this is kind of like more of a shift share, the first, the exposure to fintech, while the bank characteristic and local factors, they are really just like correlates, right? So it's very reduced form. It's like, there's no causality here or anything like that. But, you know, we take a very, you know, a broad approach. So the characteristics that we're interested in are here, like profitability, income, branch consolidation, and so on. And then we're also interested in some other local factors. So similar to kind of the exposure to fintech, we are interested in whether banks that are kind of in regions where income is higher, where there are more minorities and so on, whether this actually is related to their IT investment. So we just run this very simple specification where we run bank IT investment on all of these factors, where bank IT investment is between 2019 and 2015, and we regress that on these variables that are lagged by 5 years. So it's a cross-sectional regression. Instead of showing you the table, let me just kind of tell you what we find. So we find that, as you could already see in the graphs, bank size is correlated positively with bank IT investment. So that suggests there are some kind of economies of scale. You can also see that branch growth, for example, is, especially for the large bank, negatively correlated. So that suggests to some extent that the consolidation of branches is kind of substituted by IT, right? So I think that is very intuitive. What you can also see is that some local characteristics are correlated. So for example, banks that have a lot of IT adoption, they are lending more in low-income regions. So that may have some implications for financial inclusion. I'm going to go to that in a bit. What you can also see is that where a lot of people study STEM subjects, and when the banks are based there, these banks are also, especially the small ones, are also investing more in IT, suggesting that there's some the skill of tech, the tech skills kind of provide some incentive for the banks to invest. And then finally, we do find also some role of fintech competition. So where fintech competition is higher for these banks, they invest more in IT. So then we want to understand a bit whether at least the fintech competition is causal or not. And so we're trying to find an instrument here for this exposure. And so what's the idea of this instrument? Is that what you can see is Rocket Mortgage is now the largest provider of mortgages in the US, and so the founder of Rocket Mortgage is from Michigan, and you can see that very early on, so in the 2000s already, there was a lot of fintech lending going on in the area of Michigan, because this guy is from there. So he kind of started the business from there. And so we kind of use the distance of the footprint of the banks to Michigan as an instrument for exposure to fintech. And so you can see here that this exposure to fintech is indeed correlated with the share of deposits that banks have in Michigan. So it seems to be kind of a valid instrument. And when we use that as an instrument, we do also confirm that there is a causal relationship of fintech competition for IT investment. So now let's go to the consequences, so IT investments and the lending behavior in the mortgage market. And so what we do here is we look at the lending in the mortgage market from the HMDA data set. And we compare the lending behavior in terms of the LTV, in terms of the DTI, the interest rate, and so on, for fintech lenders that we have in this data set, for high IT banks and for low IT banks. And so basically what we find is that fintech mortgages are similar to kind of other non-banks, while the high IT banks are kind of more similar to other banks. So it doesn't seem to be the case that high IT banks are kind of starting to resemble more these fintech lenders. So when we test for the difference between high IT banks and fintech lenders, it's still really the case that they're not becoming more similar. And so that kind of suggests that the fintech lending is maybe the fintech lending is not really driven by the IT, but it's more driven kind of by the balance sheet structure or the regulation of the fintechs rather than by the IT itself. So you can see that here, for example, for log income, we compare here the high IT banks to the low IT banks. So you see the coefficient is negative and statistically significant, but it's relatively small, while the fintechs and the non-banks, they are relatively similar. And you see that basically for all these columns. So fintech and non-banks is always kind of similar, and then high IT is relatively small. So that means high IT is relatively similar to low IT. Last, we're interested in how IT investment shapes the transmission of monetary policy, and we do so by looking at the core reports and by lending volumes and by interest rates, and so there are several reasons for why IT may change the transmission of monetary policy. So, for example, there may be some supply side factors that IT kind of makes banks respond more. But then on the other hand, there's also this argument out there that high IT may actually respond less. So why is that the case? Because there may be this kind of these convenience gains from high IT out there. So for example, if you're a borrower from a high IT bank, and that may be very convenient to borrow from this high IT bank because their services are very good, it's very convenient. When they change the interest rate, you are much less responsive to a change in the interest rate because it's so convenient. So that kind of is equivalent to kind of IT allowing you to gain market power, right? So it reduces kind of the sensitivity. And so when we look at kind of local projections, what happens to lending, we can first see that in response to a contractionary monetary policy shock from here, taken from Jaroczynski and Karady, loan volumes go down and interest rates go up. So this is across the whole sample of firms. And then we look into kind of how this changes with IT investment. And you can see that banks that invest more in IT have a smaller increase in loans and a larger increase in the price of loans. So looking at it kind of together without the time fixed effect, you can see that the high IT banks, they react more in terms of the prices and less in terms of quantities. And that can basically be rationalized by this lower elasticity of the residual demand curve. So let me show you actually here the way we think about it. So here you can see the quantity on the x-axis, and then the interest rate at which the bank is lending on the y-axis. And so then when we move we have like the credit supply before the contractionary monetary policy shock, and then after the contractionary monetary policy shock, it moves to the left. And so you can see that the interest rate goes up and lending volumes go down. And so if you think about the high IT bank, they have this less elastic demand curve, where for every change in the interest rate, they actually change their quantity very little. While for the low IT banks, for every given change in the interest rate, they change the quantity a lot. And again, this is consistent with this convenience view, where like if you borrow from a bank that provides great services because of their IT, even if they change their interest rate a little bit, you're not going to change banks very, very quickly. And that can basically rationalize the fact that the interest rate for these firms, I mean, as you can see here, the interest rate goes up more if you look at R1, and the quantities respond less if you look at a Q1 here compared for high versus the low. And that's exactly kind of what we find here and here. So we have a lot more stuff going on in the paper, but these are just some results. So let me conclude. So first of all, the contribution of this paper is like mainly to kind of construct this new data set on IT investment, to make it available for others to use, because it is a very important characteristic of banks these days. Banks CEOs, executives talk about it a lot, so it should be taken into account when analyzing banks in many different ways. And then we are trying to understand a bit what's driving it and what the consequences are. I think the most important takeaways are that really the large banks started adopting IT, especially since the 2010s, quite a lot more than before, while before the 2010s it wasn't the case. And fintech competition did indeed lead to this adoption of IT. The third point is that although banks now kind of have a lot of IT investment, that doesn't mean that they are the same as fintechs. Why? Because regulation for fintechs and banks is still very different. So more IT for banks is not equal to fintechs. So let me stop here. Thank you.
Thank you, Yannick. Amanda, for your comments.
Okay, so here. First of all, thank you so much for the presentation. This was a very nice paper to read for me. The idea was very clear and it was very clear to read too, so I learned a lot. Thank you so much. I'll first to talk a little bit about the paper and its contribution, and then make some suggestions for us to discuss about the paper, right? So first, the paper addresses what are the drivers and consequences of IT adoption by banks. So the main measure, as Yannick just said, they construct a novel measure of banks' IT spending using technical words in these call reports that it was very nice and it was really a novelty. And they learned from this new measure that banks have invested in IT a lot over the years, and we have some heterogeneity in these investments since smaller and larger banks were investing pretty much at the same rate until the great financial crisis. And after that, larger banks just decoupled from smaller ones, and they are investing much more in IT than the small banks are doing so. Then they try to determine what are the factors in this increasing IT investment, what are driving these investments by banks. So first of all, as we already saw in the charts and I just mentioned, are bank size. So larger banks are investing more in IT than smaller banks. And another finding of the paper is that banks' exposure to fintech is really important. So the banks that are more exposed to fintechs are investing more in IT than the others. And to do so, they use two methodologies. They use cross-section and they use an IV estimation that tries to indicate a causal effect that it is really the case that fintech exposure is driving banks' IT adoption. And they bring several results. I'm going to point out just these 4 ones that were more, at least it were, the last 2 ones were more unexpected for me, at least when I was reading. And this is one of them, that banks that operate in poorer counties were adopting more IT than the others. And it was a little bit striking for me, at least looking at this information with my Brazilian eyes, because here in Brazil, what we see is that usually poorer counties and people that are low income, they are less inclined to adopt new technologies. They are more worried, and here in Brazil we have a problem too that we don't find in your econometric exercise. We have broadband problems and internet connection problems, and this becomes more difficult to lower income people to use internet banking. So a bank that is working pretty much in poorer counties, probably in Brazil, would not adopt IT so much, at least thinking about internet banking. And another conclusion that you get is that banks' business model and structure impacts IT adoption or not. So you guys find in our regressions that banks that earn a large share of income from non-interest sources are adopting more IT. And this is quite interesting, at least for me. And we are going to, I'll discuss more these points in the discussion and suggestions. And the consequences of this increasing IT adoption by banks are the following. So banks that spend more in IT, they are similar to other banks. So they are investing in IT, but they are not being more similar to fintechs. So they are not targeting the same clients, and they are not becoming more fintech-like. They are, and yeah, Yannick just said, we have regulation and all that. Fintechs are less regulated than banks. And also, I found very important are the monetary policy implications of these increasing in bank IT adoption, because they find that this technology adoption reduces the transmission of monetary policy to credit. So this is also a really important consequence of this IT adoption. Now for the discussion. So just as I said, congratulations on the paper. I really liked it very much. But some things that were missing, at least for me. You mentioned in the paper that the mortgage market is an ideal laboratory to study the consequences of bank ID adoption, but it was not clear for me why you were just looking to mortgage. And I think I like charts a lot too, and I think that it would be very interesting for us to learn what is the participation of mortgage in. I know that mortgage is really important in the US, much more than in Brazil, for example, but I don't know what is the participation of mortgage compared to other loans. And is mortgage very representative, or do you have other types of consumer loans that is very important for the economy as well? And when you get to the conclusions, you drive conclusions that seems, at least for me, that they are very general, and that we could use these conclusions for all loan types, but you are driving this conclusion, use just one type of loan that is mortgage, and that is very different from other types of loans. And for example, you get the result that the bank structure is really important. So for example, that banks that earn a large share from non-interest sources, they invest more in IT than the other banks. But I wonder if this result is general, it is for all types of loans, or if you get this result just because you are analyzing mortgage loans. And why do I get this? I have this doubt, because I don't know, I would have to investigate and study this more, but I have the impression that that these mortgage loans, they have to do more with customer loyalty than to banks' profitability. So I think that maybe this bank structure result comes from the loan type that you guys chose. And another variable that I think that I missed was age, because you have income, but maybe age and mortgage and this technological usage, maybe it is more related to younger people than to older people. So that's it. Thank you very much.
Thank you, Amanda. Let's collect questions from the audience.
Can I just ask
Yes,
to
yeah.
Yannick? Okay. So Yannick, I think it was a very interesting paper. And since you mentioned that one of the ideas of the paper is to build this data set with IT technology, I was thinking of an old paper about the global financial crisis that looked at the users of TARP, and they found that one of the things that would differentiate who would use TARP and not was the ratio of the chief risk officer pay relative to the CEO pay. And I was thinking that perhaps if you could find the chief technology officer ratio relative to the CEO pay could be another interesting thing to look at.
Okay.
Very interesting paper. I found your point about market power and response of banks very interesting. The only thing you said, I think that the loan rates respond more for IT banks. I think it makes sense to look at deposit rates, because what I would expect to see that deposit rates become stickier, because if banks become more convenient, we should expect them not to react as much to monetary policy. So if you can show that, that would be great.
Hi, thank you. So my question is about the IT expenses. Is that like an additional extra burden to the bank, or it's crowding out other expenses of the bank? So it could be like bank cutting some other expenses and adding this IT expenses. That's my question is about. Thank you.
Yeah, so you showed that high IT banks are still more similar to other banks rather than to fintechs, right? So, but I think the way you make this claim is looking at the clientele of the banks and responses such as LTV, DTI, etc. But I wonder whether you see other responses that are more similar to fintechs, like whether high IT banks will, after the adoption of IT, will be able, for example, to lend to further borrowers and to speed up, the process of giving loans. Because one of the main advantages of fintechs in the literature is the speediness. So I don't know if you have a way to measure that. I mean, borrowers would take little time, fewer time to get a loan from high IT banks than from other banks, and more similar than to fintechs. Thank you.
So
Very short, please. Very brief.
very brief. So from your results, can we then conclude that this investment in IT is also helping expand financial inclusion, given that you're finding that it is banks catering lower income individuals?
Okay. Well, thanks a lot. These were great comments. Yeah. So I think the age is super interesting. We don't have. So let me say, so we use the mortgage market as kind of this laboratory. Why? Because in the HAMDA data set, we have information on lenders that are not banks. So there we can make the comparison between banks with high IT, low IT, fintechs, and non-bank. So that's the only data set where you can really do it. I totally agree with everything you said, that it would be nice to do it in others. I agree. So I think age is not available, but I have to check. Maybe it is later. But I think it's very consistent with that it's negatively correlated with income. So the high IT banks, also related to your question, high IT banks are lending to low income. So do fintechs. So, and that is, I mean, suggestive of helping with financial inclusion. Also, one way, what we can see is they also lend a bit to riskier borrowers, high IT and fintechs. So there's a bit, maybe if you will, the trade-off between more financial inclusion, but then also potentially a little bit more financial stability risks. Again, low income is negatively correlated with age, so maybe it's all driven by age. We haven't controlled for it. I don't think we can. And also, like, if we kind of look at the drivers, you see, like, so we have like IT on the left-hand side, and then poor like income of the county on the right-hand side. But it's really just a cross-sectional regression without anything. So it's actually consistent, like that it's the other way around, right? Like high IT drives, you know, like they lend in. So then Raquel, yeah, I think this is a really nice idea to look at this. So actually, in a paper that we published last year on in the JME on bank IT investment, we use this measure from Hard Tanks on the PC per employees. But then what we also do is we look at the executives of these banks, and we look for, similar to how we do it here, for like these IT keywords and their biography, and then we kind of classify banks in that way. We actually haven't correlated that with this measure yet, but I think also the compensation and the I think the CTOs should also be there. We take all of them and then look like, so if they, for example, studied engineering, we classify them as IT executives.
Right.
So, but we can also do what you suggested. Then the question on monetary policy and deposit rates. Yeah, no, I think this is super interesting. We haven't looked at deposit rates yet. Of course, I mean, there's also a super interesting question now, to what extent actually IT investment led to like a higher deposit betas. I mean, so actually like SVB has a relatively high IT ratio in our data set. So, and there's this like recent paper by I think Luigi Zingales and Rajan, I think, and they show that like more IT investment leads to higher deposit betas, right? So because you have like the app available, so it's easier for you to kind of. So we wrote this paper before, obviously. So, but that was just, yeah, it would be very interesting. Then what are the other consequences? Speed we can not look at, unfortunately, but we do see that they lend further away. So we have this measure of like the distance between the headquarter and where they lend. And you do see that banks that have more IT investment lend further away. Also, back then, I think it was also Rajan and Peterson, they used this very rough measure of IT investment where they said, how many loans do you make per bank employee? So basically, if you have like very few employees and make a lot of loans, then you are like a high IT bank, and our measure also correlates positively with that. So it seems to be. Last point on whether there's kind of a substitute between like other expenses and IT. I think that is true. I mean, I think we have suggestive evidence that it's true. So for example, you see that banks that do consolidate their branches, they have more IT investment. You also see that banks that have like low profits actually invest more in IT. So, so it seems like kind of they're trying to kind of get out of this misery and try to kind of, you know, like try to kind of push themselves out of it by investing in more IT. Thank you very much. These are all great questions.
Okay, thank you. Then in the name of the Central Bank, I thank Yannick, Amanda, and Raquel for the papers and for the comments, and also the audience. Thank you.